Welcome to this explainer on Market Plainly. Today we're diving into a massive modern paradox. Almost everyone has heard of BlackRock, right? Yet very few people actually understand what the world's largest asset manager really does.
It's become this wildly pervasive internet myth that BlackRock secretly owns the entire world. You see it in comment sections, on viral videos, everywhere. But the reality? Well, it's both way more complex and honestly a lot more fascinating than the conspiracy theories.
So, the crucial first step here is understanding the difference between a principal, someone who actually owns an asset, and an agent, who just manages it. BlackRock, they're an agent. The trillions of dollars they hold don't belong to them. They belong to third-party clients. We're talking public pension funds, insurers, and everyday retail savers like you and me. Because BlackRock is just managing other people's money, their own corporate bank account isn't taking that direct risk. And this agency structure is exactly why they sailed through the 2008 global financial crisis relatively unscathed, while traditional commercial banks were left holding the bag.
Section 1. Rise of an Asset Manager.
To understand how they got so incredibly big, we actually have to look back at an epic early career disaster. So in the 1980s, co-founder Larry Fink pioneered the mortgage-backed securities market at First Boston. But he took a sudden $90 million loss that exposed a pretty catastrophic failure in risk modeling. Ouch. But that sting convinced Fink that the future of finance would depend entirely on sophisticated risk management. Fast forward to 1988, he and 7 partners founded a new firm in a single room, backed by a $5 million credit line from Blackstone. By 1994, after some really rapid growth, they split off to form the independent entity we know today as BlackRock.
And this early foundation established a truly genius, low-risk business model. See, BlackRock earns highly predictable recurring revenue simply by charging management fees on the assets they oversee. The math is simple. Their base fee revenue equals their assets under management multiplied by their fee rate. So as global markets grow and new clients pour money in, BlackRock enjoys this incredible compounding revenue multiplier, all without taking on the proprietary risk of actually owning those assets.
And man, that compounding effect is staggering. Driven by massive client inflows and global market growth, BlackRock's assets under management reached a record-shattering $15.3 trillion by mid-2026. Just to put that scale in perspective, they captured $321 billion in net new money in just the first 6 months of that year alone.
Section 2. The Passive Investing Revolution. A huge engine for BlackRock's massive scale is a fundamental shift in how millions of everyday people actually invest today. Over the past 2 decades, we've witnessed a massive passive investing revolution. Millions of investors abandoned expensive, actively managed mutual funds, mostly because, let's face it, active managers often fail to beat the market over the long term. Instead, money just flooded into low-cost, index-tracking, exchange-traded funds, or ETFs. BlackRock capitalized on this perfectly. They turned their iShares brand into an absolute behemoth that now captures roughly 32% of the entire global ETF market.
This huge migration of capital essentially created the so-called Big Three: BlackRock, Vanguard, and State Street. Together, these 3 firms collectively manage over $25 trillion. And because their index funds are required to hold all the stocks in a given market indefinitely, they become universal, permanent owners with dominant equity blocks across the S&P 500. But sitting comfortably at the absolute top of this mountain? Yeah, that's BlackRock.
Section 3. Aladdin, Global Finance's Brain.
Now, BlackRock's true systemic leverage isn't just in the $15 trillion they manage directly. It actually resides in a proprietary technology platform called Aladdin. By late 2025, Aladdin monitored and processed risk analytics for roughly $25 trillion in assets. Let that sink in for a second. That is a staggering 7 to 8% of the entire global financial system.
What started as Larry Fink's internal risk management tool has quietly evolved into the central nervous system of global finance. Aladdin provides banks, insurers, and governments with absolutely critical portfolio stress tests. Using massive computing power, it runs Monte Carlo simulations to model extreme scenarios. We're talking sudden global pandemics or Lehman Brothers-style collapse. Executing 5,000 portfolio stress tests weekly and supported by thousands of engineers, many analysts actually consider Aladdin to be BlackRock's ultimate competitive moat.
Section 4. Influence, ESG, and Politics.
Now, with unparalleled scale and indispensable technology comes immense geopolitical influence, which, as you might guess, naturally attracts intense scrutiny. Because of Fink's deep background in structured finance, BlackRock's analytical expertise made them the go-to advisor for Washington during the 2008 financial meltdown. The U.S. Treasury actually hired BlackRock to manage the toxic assets of Bear Stearns and AIG. This established them as a critical intermediary in systemic financial reconstruction, and it's a powerful role they continue to play for governments worldwide today.
However, this influence has placed BlackRock right at the center of some fierce ideological battles, particularly around ESG. Environmental, social, and governance investing. Supporters argue ESG is vital for long-term sustainability and mitigating climate risk. On the flip side, critics, including several conservative U.S. state attorneys general, have accused BlackRock of violating its fiduciary duty. They claim the firm prioritized political agendas over financial returns for pensioners. In response to all this, Larry Fink distanced the firm from the highly politicized term ESG. He reframed their approach around what he now calls industrial materiality. And to address concerns over their massive voting power, they pioneered the Voting Choice Program, which allows eligible clients to bypass BlackRock entirely and cast their corporate votes themselves. This massive influence also heavily shapes regulation. Following 2008, regulators wanted to label huge institutions as systemically important. This would basically force them to hold massive, bank-like cash reserves just in case of failure. While BlackRock aggressively fought this, they argued that because they just manage money rather than own it, forcing them to hold capital reserves would only drive out costs and hurt the retirement returns of everyday people. Instead, they successfully lobbied for a rulebook that focuses on regulating risky market behaviors across the board, rather than punishing individual asset management firms.
And you know what? That lobbying paid off. In early 2026, the Financial Stability Oversight Council voted unanimously to adopt this exact market-wide approach. Regulators are now focusing on monitoring structural risks rather than disrupting asset managers with costly bank-style capital requirements. It was a monumental, behind-the-scenes structural victory for the entire asset management industry.
Section 5. Debunking the housing myth.
All right, we have to address the elephant in the room. The viral, incredibly persistent myth that BlackRock is outbidding regular people to buy up all the single-family homes in America. The root of this widespread confusion actually stems from people mixing up two companies with almost identical names. You've got Blackstone, the real estate giant that aggressively bought up foreclosed homes to rent out after 2008. And then there is BlackRock, the liquid asset manager. Turns out, a single word difference is enough to spark a global conspiracy theory. Furthermore, when we look at the actual evidence regarding corporate homeownership, the data tells a very, very clear story. Large institutional investors actually own less than 4% of single-family rentals nationwide. The vast majority, over 96%, are owned by small, mom-and-pop landlords. The terrifying narrative of Wall Street hoarding all the houses simply isn't supported by the empirical data.
And specifically regarding BlackRock, the exact number of individual U.S. single-family homes bought, owned, or managed by BlackRock is zero. Absolutely zero. When analyzing institutions with this much systemic power, it is so crucial to distinguish verified facts from social media misinformation. Section 6. The power of managing capital.
So, if they don't secretly own the housing market and they don't own the world, what exactly is their endgame? Well, as Larry Fink pointed out recently, the world requires massive capital to solve structural bottlenecks. We're talking things like an estimated $10 trillion in infrastructure to power the booming AI sector, or funding public pensions for an aging global population. BlackRock's true strength lies right here. They are acting as the ultimate, indispensable financial intermediary, connecting the world's capital to the world's biggest challenges on an absolutely unprecedented scale.
Before we wrap up, thank you so much for watching this explainer. If you enjoy business, finance, and economics explained plainly, hit that subscribe button to Market Plainly. And jump into the comments below. Do you think BlackRock's greatest strength is its massive scale, its Aladdin technology, or its geopolitical influence? Also, let us know a company you'd like to see featured next. Ultimately, BlackRock's true power doesn't come from owning the world's assets, but from managing capital, providing technology, and connecting investors with global markets. Make sure to join us for our next explainer, Visa's invisible business model. Until then, I'll leave you with this. The next time you look at a stock ticker, just remember the most powerful force in the market isn't the one making the trades. It's the one writing the code that tells everyone else how to trade.